You've probably heard of infinite banking before, but how does it actually fit into our investment strategy? In this episode of the Passive Income Playbook on the Best Ever CRE Show, we're joined by Chris Miles, known as the Anti Financial Advisor. Chris built a successful career in traditional financial advising and until the great financial crisis wiped him out in 2008. And that experience changed everything for him. It led him to rethink everything he'd been taught, walked away from Wall Street, and rebuilt his wealth using alternative strategies, starting with cash flow, private real estate deals, and infinite banking. Today, Chris has invested in over 10 passive deals across multifamily, oil and gas, and debt funds. And he also coaches LP investors on how to design portfolios that generate income now and not just someday. In this episode, we'll also unpack the lessons Chris learned the hard way, how infinite banking fits into his strategy, and why he believes LP investing with limited liability and leverage is one of the smartest moves you can make today. And with that, let's dive in. All right, welcome, Chris. Happy to have you here.
Hey, same here. It's good to be on.
Yeah. So, Chris, I want to get into all the different, strategies of how you're approaching investing. You do a little bit of LP investing yourself. You were a financial advisor at one point. You now, use and are well known for strategies around infinite banking, and you now also coach a lot of people. But I'd love to, before we get into all of that, I would love to kind of start at the beginning and just have an idea of who is Chris and why are we listening to you? What's your story, coming of age story?
Yeah, coming of age. I mean, I was raised probably like most people, by parents that were always in scarcity about money. We can't afford this. We think I am made of money. Money doesn't grow on trees. Those kind of things. I also grew up hearing my dad say that he believed that he was of the generation he thought if you just work for a company for 30, 40 years, they'll treat you right, they'll take care of you. And then he found out that wasn't the case. And by his 40s and 50s, he'd already had strokes and heart attacks. So he basically would tell me, he's like, Chris, I'm never going to retire. My job will literally kill me. And so when I went to college, I vowed I never want to be like him, so naturally I go to college, so I could become another, automaton, right? But anyways, I go there, I realize I want to be more in control of my life. And that's where went more down the entrepreneur path. But I figured if I was going to become a business consultant, that wasn't the original goal. I should probably have real life business experience rather than just get an MBA. So I took a sabbatical from college. I said, let's just take a year off, find some business to start. And then from there, maybe I'll go back to business consulting. Well, I was kind of searching around. I didn't know where to look to start a business or what business to start for that matter. And then I had a friend I was talking to that just got hired by a financial firm. And it sounded kind of interesting. He's learning about money, right? And I was kind of like Adam Sandler in The Wedding Singer. He's like, when he's going in for that job interview at the bank, he's like, I like money. I like to have more of it. Have a jar on top of the fridge. I like to add to it. That's where you come in, right? That's kind of what it was like for me. So I interviewed. I didn't realize they took anybody off the street as long as you could pass the test with 70% and not be a murderer, right? And so I got hired and I started doing that. I loved, I was fully commission only, loved working on my own and learning the ropes and the personal development that comes behind business. And so I actually never went back to college to finish up. So I dropped out, stayed down the entrepreneur path. And after 4 years, my dad reached out to me. He's like, well, Chris, when are you going to advise me? Now, understand my dad never showed me anything about his money, right? He was very guarded. He was always afraid people were trying to steal his money. He was the penny pinching, cheap son of a gun that, was out there. He's the kind of guy that bought everything on sale. Like I seriously had Fruity Pebbles for an entire year straight because it was a case lot sale. And then the next year we switched to Cocoa Pebbles, my dad still has 20-year-old plus Mrs. Buttersworth on his shelves just because, it was on sale. And so that's the kind of guy he was. He always taught me just to scrimp and save, which being a financial advisor made it easy because they all teach you to be, slave and save away, right? Always live in scarcity. So long story short, I sit down with him. I'm looking at his finances. And I said, Dad, you're 61 years old. If you want to retire today, despite the fact that you are 100% debt free, you've paid off your house and you've been stuffing money in your 401k, getting the match from your employer and everything you're supposed to do, like good boys and good girls should, right? You're going to have to die in 5 or 6 years because that's when you're going to run out of money. Okay, what do I do then? What else can I do? I was like, I don't know. You did everything right from what I teach as a financial advisor. And that bothered me. I didn't really have a good answer for him. I was like, this is 2005. So I'm like, I could put him in the market, but what if the market goes down again like it did in Y2K, which by the way, a few years later it did, right? And I just didn't have confidence to tell my own father, hey, gamble on this and hopefully it works out. But if I get it wrong, you lose everything. And so I didn't know what to do. And just a month later, I'm talking with a friend of mine that I trained to be a financial advisor, but then he went and left to go do real estate investing. Not so much as an LP. He was more on the GP side, right? And he was doing that. He was doing more fix and flips. I'm talking to him. He's like, Chris, my life is amazing right now. My dad and I have partnered on some real estate deals, and we've doubled his income as a professor at the local university. I said, wait, hold on. You just started this like 5 months ago. How is it possible that your dad, who I sat down with as a financial advisor that did not invest with me, I'm still a little sore about that one. But then he went and goes do real estate investing. Now he's doubled his income as a professor. How is that possible? That's too good to be true. There's no way that's possible. He's like, Chris, let me ask you a question. How many of your clients are actually financially free where they don't worry about money? I said, well, even the retired ones worry about running out of money. So none of them. Good job, Chris. How about this? How many of you guys as financial advisors are financially free, not off the commissions you're earning, but actually doing these same investments you've been recommending? And at the time, I remember there's guys working there since the 1970s. And I could tell they were nowhere close to retirement. I was like, none? Maybe none of them can. He's like, that is your problem. Okay, well, give me the answer. I won't give you the answer. I'm like, come on, give me something. He finally says, if you're really serious, I don't think you are. By the way, he wasn't selling me anything. He was just pissed off because I was arguing with him for so long in this conversation. He's like, if you're really serious, get this book by Robert Kiyosaki called Who Took My Money? It's a lesser known rich dad book. And then go listen to this AM talk radio show with these two real estate investors chatting about, real estate and principles of wealth and things like that. And so I did exactly as he said, started going down that rabbit hole, right? Almost like the Matrix red pill I took, and next thing I know, a few months later, I'm sitting in one of their events and they're talking about all this stupid stuff of like, hey, how the financial advisors tell you to, high risk creates high returns. Well, how's a 90% chance of losing create a 90% chance of winning? That doesn't add up. By the way, you're in it for the long haul. When the market goes down, how long does that long haul become? And you're diversified, but you're only in mutual funds, which are just stocks only and bonds, and they're all the same asset profile. Like they just start ripping into all these money myths. And I'm like, yeah, who would teach this crap? I'm like, oh crap, it's me. Like I'm the guy. I'm the one teaching this stuff. So after that weekend, I actually quit the next Monday. Vowed never teach about money again. I said I will just be a mortgage broker and I'll teach ballroom dancing on the side and do a little stock trading. And that's what I did. But anyways, like later that year, of course, I wanted to know how these guys, because a lot of them were in their 20s and 30s, financially free, multimillionaires. I'm like, how did they do it? I want to learn what they did. I started more on the active side in the beginning. And so I started doing that, but I learned about the passive side as well. I learned that you can actually lend your money to real estate investors and make money off that and make double-digit returns. And it blew my mind what was possible. I mean, for example, at this time is a little bit richer. I remember there's like people doing hard money loans at 2% a month. And I did the math. I'm like, wait, if I have $100,000, instead of the financial advisor way, which is pull off 3% a year, because the 4% rule was debunked years ago, even though there's still idiots that teach it. But 3% a year, you pull off that 100,000 in a mutual fund, that's 3,000 a year. But if I get paid 2% a month on 100,000, that's 2,000 a month. I make almost as much per month as I thought I'd make per year in the financial advisor world. And so I started going down that path, and I did I turned my starter home into a rental, almost like my own little burr of sorts, right? And the next thing I know, I'm 28, almost 29 years old and have enough passive income that I could literally retire. And I was like, what we call work optional, where you work because you want to, not because you have to. Blew my mind. Never thought it was even close to being possible, but I did it. And of course, after a while, you get friends and family saying, okay, how are you a 28-year-old retired guy? How is that possible? So eventually, I kept trying to teach people how I did what I did. Eventually came out of retirement, so to speak, in 2007 to do that same thing, teach people how to escape the rat race, and did that for a while. But unfortunately, 2007, a lot of people who were teaching this stuff were real estate flippers. If you know what happened then, real estate flippers were the first to get hammered because the banks started tightening up their the credit market, and nobody knew, but we did. I even knew because I trapped money in my equity of my house, thinking I could always pull it back out as a mortgage broker. And then all of a sudden the banks are saying, nope, you can't touch your equity at all. And then I'm watching the values tank. I went from literally a millionaire to upside down millionaire, where I was over $1 million in debt by 2008 going into 2009. And so I had to dig out of that debt hole. Eventually did. It was a long, hard journey, and we can go into that later if you want. But eventually by the end of 2016, December 2016, I finally got out of the rat race the second time, where I had over 10,000 a month passive income coming in. And it was passive. I wasn't doing the active stuff anymore. Now I was more on the side that you talk about, like being the LP, right? Being the person that's actually, the person that's actually like investing with other investors versus doing it myself. So the passive path has definitely been a lot more fun than the active path in 2007.
Very helpful to get that kind of introduction. Thank you. A lot of things to dive in there. I think I had a very similar story to you. I think it's easy when you're young to buy a couple homes and you live off of the $3,000 or $4,000 you make
Yeah.
a month. 10 years ago, it was a lot easier to make money actively, I think, in real estate than it is today. Um, but I, you know, also like you, didn't even know that this stuff existed. And, I'd love to kind of get a better idea of how did you transition? What was the kind of the thing that made you decide, hey, I'm going to start LP investing? I know you started your LP investing journey in 2017,
Mhm.
and I think you've done like 10 or so deals across like multifamily, oil and gas. You recently did a debt fund. Would love to kind of get into that a little later, but what do you think was that point in time, and what changed?
You mean what got me to do that instead of being an active investor? Is that what you're asking?
Yeah, exactly.
Yeah. I mean, I think just how badly I got burned, because to slow it down a little bit, I mean, going back to 2006, 2007, you know, I thought I was amazing as an investor, right? But the truth is, it was kind of like being a real estate investor in 2018 or 2021 for that matter, right? When anybody and their dog can make money in real estate, right? You could be a complete idiot, just buy for a few months and the property would appreciate. That's the kind of market it was. And so I thought I was a genius. And that was kind of the humble pie I got, right? Like with the greater the pride, the greater the fall, and that's kind of what happened with me is that I thought, you know what, this is good. And I was thinking of this too. I was banking on appreciation. This was the big mistake I made. And this does apply if you're a passive investor, because a lot of times you're looking at deals, you'll see people that literally like say, hey, this will only work if you do a value add, right? Like this will only appreciate if the cap rates stay the same, right? And all that kind of stuff. Well, that's what I was doing too. I was like, you know what? If I buy a property and I put, 20% down, like if I buy 100,000 property, if it goes up 10%, I make $10,000. Well, what if I buy a $500,000 property and appreciates 10%? Then I make $50,000. So maybe I should just go bigger. Let's buy the bigger homes. The homes are way above the average for the market at that time. Now that's like cheap, buying a $500,000 property. But we're like trying to buy, properties like much higher. And the problem is that when you buy way over the average, there's bigger swings. Yeah, they can go up, but they can also come crashing down faster too when things tighten up. And that was the problem I ran into. And on top of that, I mean, it wasn't just that. I remember like when I rented out my starter home. So here's what I did with my starter home. It was kind of creative. I sold it off to an investor at full appraised value. Then I leased it back from that investor, paying him just slightly above what his mortgage payment was at that time. And then I went and I subleased it out and rented it out to a renter. And then I was managing the property. So he's like, hey, this is easy. I'm just using my credit to make an infinite rate of return with my credit, right? Being a credit partner in this sense, I'm stripping out all the equity so I can use that to invest and I'm renting out my property. But the problem is I rented it to the worst person I could possibly rent it to. It was a person that lived 2 blocks away. I even went into their house, saw the way they treated their place. I should have got a hint to say, oh, I shouldn't do it. But I was just so desperate and like greedy. And I was just trying to move too fast that I wasn't patient enough to just say, you know what, I need to find the right renter for this place. And I didn't do that. So not only did they not pay me very well, they was very inconsistent, but they also trashed my property. The only thing they didn't trash was they built a doghouse, which by the way, I had a no pet policy. But that doghouse, when I tried to have the 1-800-GOT junk to come over, we could not break that thing. They put holes in the wall. We had pizza stuck on the carpet, all this other kind of crap. However, we could not break down that freaking doghouse. It was well built, and that's the thing that I realized. Like I'm a really bad active investor. I was a bad property manager. Like they gave me a sob story. I followed it. I was like, okay, fine. I'll give you a few more weeks. I get it. I know times can be tough. And then in the meantime, I'm not getting paid, and while I'm still paying that investor for that lease payment that I'm paying him. So those things like that, like all of a sudden my cash flow is getting tight. And outside of the real estate, I started that new business in 2007. But like I said, we were focused on real estate flippers who were all going broke, so they couldn't pay us. So we had this brand new business with all these extra costs. I even pulled out a little tiny SBA loan to put into it too, and everything else. And now we're not cash flowing at all. So between my business and my personal expenses, that my expenses have risen up to about 22,000 a month, but I was only making 5 or 6,000 a month in that business. So you do the math. I mean, it doesn't take long. Even if you have a good savings cushion like I had, even if you didn't have a lot of credit card debt, which I didn't initially, but I started running up all those credit cards thinking, oh, we'll turn a corner here in our business soon. Or, hey, you know what? I'll try to use my savings. So, I mean, I was getting desperate. Then I tried to go to the equity of my house. And then the bank say, sorry. And this was in the summer of 2007. They're like, sorry, we don't lend money to business owners anymore. And so all the equity gets trapped. And of course, I bought a new home that was a nice little McMansion. And it was like a show home. And that thing starts depreciating. So pretty soon I went from trying to get equity out to all of a sudden saying, maybe I can sell it. And then pretty soon is, okay, now at this point, all the equity has disappeared. Even though I had 150,000 equity, it's now gone. Maybe I can short sell it. And then they reject the short seller that we got because it was owned by Lehman Brothers, who was committing fraud practices then. And so we couldn't even short sell it. So finally it was 2009. I foreclosed on that property. It sold. Instead of the short sale we had for 515, about a year or so later, they end up foreclosing on it for 342. So for about almost half the price of what that house used to be worth, a little less than half of what it used to be worth just a few years prior. And so I was just devastated, right? And so, I mean, that actually is what got me scared to even get back into investing again. So even when I started to get things under control, I didn't go bankrupt, but I would have been better off if I did because it would have been easier. I was negotiating and trying to pay off debts and stuff, trying to rebuild. Eventually, we did pull our business out of a big, almost out of bankruptcy back in about the end of 2009. We started to pull that thing out. So 2010, 2011, I'm just 12. I'm just paying off debt like crazy, just living as cheap as I can, paying off debt. And finally get to a point where now I can start building some cash so I can start investing again, right? But then, of course, all those traumas come back up, those fears, and I know I'm not alone. I know there's several people on this that probably had that before, especially if you've invested in syndications or anything the last, say, 3 to 5 years, you probably have felt it. Like I was scared to jump in. I remember trying to buy the first rentals. This time I was going for the turnkey rental because I knew I was a bad property manager. So I started doing turnkeys instead. And that was better, much better. But I mean, I was so scared to death. In fact, by the way, I bought rentals before I even bought my own house again because I was renting up until that point. So I was buying rentals while renting, ironically. But even when I bought my own house, when I finally bought my own house, I think it was 2018, I finally bought a house. I was panicking because it was almost the same exact price of the house that I foreclosed on that I bought, or lost almost 10 years prior. So anyways, I had a lot of trauma I had to overcome, but I started to have faith knowing if I could find partners I could trust in and rely on, maybe I could create a new experience, a new memory. It's the same thing I do in marathon running. I had marathons that were so painful that got me to quit running marathons for several years. Those were the ones that I did next. Like when I started to go back into marathon running, because I knew I was so scared of those races. I was like, I got to create a new memory. And same thing with investing. I had to create new memories to the point where I started to build my faith. And then I started having, like you mentioned, like 2018 or 2017 or whatever it was, I started getting into like, LP type stuff with like multifamily and whatnot.
I imagine that having that kind of experience, one, is pretty common, especially if you've been LP investing in the last couple of years.
Mhm.
But I think maybe if I'm pulling a thread here, is that one, you realize you weren't someone who loves to do active ownership, or
Mhm.
frankly, unless you're doing it at scale and have a team, it is a second job.
Yeah.
But that it limits your liability. Is
Yeah.
that thread I'm pulling here? Talk about that a
That's
little
another
bit,
great
because I think
perk.
that's
I
an
mean,
underrated thing.
it
Yeah.
is. It really is. Yeah, you're absolutely right. I mean, that if anything does go wrong and there's lawsuits happening, you're not getting sued, which I think is a huge advantage. And by the way, I've been offered GPs on deals because, I've had a podcast now for 11 years, the Money Ripples podcast. I've had people say, "Hey, I'll make you a GP if you drive people to my deal." And I was like, I lived during the last recession. I watched what happened to guys that were promoting deals or getting paid on the back end, for, driving people to it. And there's, and especially in the state of Utah, there's a big thing called affinity fraud, right? Where friends and family and neighbors will say, "Hey, I'm doing this investment. You should do it too." And then they might get a little referral kickback. And then when all the cars came tumbling down the recession, what's happening? Those people are getting sued just as much as the owners of those investments, right? So, yeah, I was like, no, don't put me on that. And that's one thing I tell my clients too is like, hey, listen, if I connect you with deals, like I'm not getting paid on the back end because I don't want that liability, right? Same reason why I'd rather be an LP than a GP. I just don't want that liability to go blow back on me because, I got some sort of perk or benefit because I connected you to something.
So am I understanding you correctly that if you're an LP, the most you can lose in, most cases is that you can only lose the money that you invested. But if you're an active investor, that you are liable for much more than that. Not only the money that you invested, but if the property goes down below the loan value, you're on the hook for that. And so I'm imagining, yeah, that's maybe like a bonus that many people don't appreciate as part of the cycle. Thoughts?
Yeah, that's true. I mean, a lot of us as LPs, we think, oh, it'd be horrible if I lost all my money, 100%. Because if there's ever an argument for the stock market, you're not likely to ever lose 100%. But if you're somebody who's on the hook, somebody actually's owned the deal, yeah, you might have some bigger upside, you might have some other fees and returns you can make. You can lose more than what you put into the deal, right? Not just your time and energy, but also money. People can come back and try to, sue you, obviously, if they try, or they may or may not be able to, but they might do that too. So there's definitely ways you can lose more than 100%. And that doesn't seem like it makes sense in a passive investor world, but in a business owner world, that's very much the case. You can literally be sinking money in. I can't tell you how many of my friends that I have that are GPs on deals. And I mean, they're literally like tapping into their life savings, their family's own funds, everything else, just trying to keep a business afloat, so that they don't lose investors' money because they really do value their integrity. But at some point they're like, "I'm sorry, like this is it. I can't risk my family anymore at this point because otherwise I'll go bankrupt and then everything goes under and then there's no hope of getting any money back." Right. So that's the thing. You got to be very careful if you're a GP on a deal. Like it might sound great. There's high upside, but there's a lot of downside risk too.
And so I guess like was that the key reason why you went into LP investing, or what made you want to make that switch?
I think it was just for me, it was really attractive to be more hands off on the investment, because I really believe that, you should do what you love in life, like you should follow your passions, follow the things that maybe you felt called to do. I mean, even the fact I created Money Ripples, right? Like after I split off from my previous company in 2000, I started in 2007, 2012, I started Money Ripples. I mean, even that, like the whole name, the whole reason I call it Money Ripples is because already to that point, see, I wasn't in 2000, after 2008, I wasn't teaching people how to get out of the rat race because I was now back in it. I would felt like a complete fraud, right? I'm the perfect guy for you to play poker against because you will win every time because you will know whether I have a good hand or not. And so I knew I couldn't teach people how to get out of the rat race because I was back in it. So I started teaching people how to do what I was doing, which was get resourceful. How do you find and free up cash? How do you find money that maybe you didn't realize was there? What are creative ways to pay off debt? Because I was having to do it myself. Now, I wasn't telling people I was flat broke over $1 million in debt, or in other words, $1 million broker than the homeless guy on the street. On welfare, by the way, I was actually on welfare, food stamps, as the guy that was just a few years prior, financially independent. I was also, my wife even threatened to move out, take the kids with her, and say, "Hey, wait, once you figure your crap out, I'm getting collector calls all hours of the day. Even while I was in meetings with clients, like I'd have to silence the phone to avoid those collector calls. All that was happening. So obviously, I'm not telling people, "Hey, I'm broke. You should hire me." So I was just trying to create value because I learned that the one thing that always works, no matter what, is that dollars follow value create. So I started like helping people with the problems they had. The people even say, "I would love to know what you know, Chris. I just don't have the money to pay you. In the back of my mind, never verbally, because that would be suicide for business. But it's like in the back of my mind, I'm thinking, I wish I was as well off financially as you are right now. So I tell him like, well, if I can help you find the money, would you pay me? Like, yeah. I'm like, cool. Here's things you can do. I knew I was onto something pretty crazy when I told this one woman who was fresh out of college. I said, hey, if you actually want to free up $250 a month, take your credit card and pay a bunch of your monthly bills, like, anything you can, utilities, your food costs, gas costs, everything charged up there. Then that couple $1,000s that you save up from that, use that to pay off your car loan. And yeah, your credit card will go up about $50 a month, but you'll free up $300 a month on your car loan, saving yourself $250 a month with zero out of pocket. She was like, did you just tell me to basically indirectly use my credit card to pay off my car? I'm like, I guess I did. She's like, that's crazy. And that's what I started to do. I just got really creative, helping people find ways to free up taxes, especially entrepreneurs and business owners and whatnot. And that's where literally like we started creating a whole new program that was freeing up on average $2,800 a month for people, not even doing anything with investing. And so anyways, I mean, the reason I bring that up is because, my whole business model had changed. And then I went and launched this new company. I thought about all those people I had helped. I mean, literally, I remember 2010, we had 250 new clients that we had. So we made like over $5 million that year. And I thought about all those people that literally freed up millions of dollars, like millions upon millions of dollars they freed up. And I thought about that ripple effect that happens, right? Like specifically, there's a chiropractor. We worked with a lot of chiropractors and dentists. There's a chiropractor we worked with that we freed up $6,000 a month. And then that first month, they bought a $6,000 four-wheeler, which if you were Dave Ramsey, you'd start, give them all the guilt trip. But I didn't do that because I knew what they were doing, because this guy was working 5 or 6 days a week, too exhausted to really spend a lot of time with his family he loved so much. But because of that $6,000 a month, his wife is saying, like, you don't understand that four-wheeler represents something much bigger than the four-wheeler. It's like for us, like that $6,000 a month gave him permission finally, because he emotionally could say, I'm not going to work the weekends anymore. I'm going to take time off and be with my family. She's like, you don't understand that four-wheeler. He's out there every single weekend, riding around with my kids, having fun. I got my husband back and my kids got their father back. And that's when I realized, like, it was that ripple effect, right? Because it wasn't just about them creating comfort in their own lives, which was awesome, of course, but it's about what it was teaching the kids. What kind of legacy is starting to create for the kids and generations beyond them? What does that do for the community? Because when you're not worried about your month to month, trying to pay bills and things like that, even if you make high income, still you're so focused on you don't really worry about the world around you. Now you can actually bless the community, the country, and ultimately that ripple effect goes across the world. And that's when the name Money Ripples popped in my head, right? And so I bring that up because I really believe you should do what you love. Like you should be doing that. And even for me, that responsibility to come saying, listen, I could just live fat and happy off 50,000 a month passive income right now and not even have a business, not even worry about Money Ripples, right? Not even worry about a podcast. Even I could just live fat and happy, but would I really be happy? Right? Because if I'm not really going about doing good and blessing more lives, then I feel like my life's meaningless. And so rather than being on some beach somewhere, just enjoying my time and my passive income, I want it to be about other people. And so that's why, for me specifically, why, I really want to be more of a hands-off investor, because by having my time freed up, having that time freedom, it allows me to do what I'm doing in Money Ripples, right? Not to mention, it's always good to live what you preach, that helps too. But that's why I do it, because I know I can actually help create a bigger ripple effect. I can use the money I'm making as a megaphone to get people away from crappy financial advice that you hear from the Dave Ramseys and the Susie Ormans of the world, all the advice that's out there telling you, just set it and forget it. You're in it for the long haul. Just, take high risk, create high returns, even though the companies you invest with never take the high risk. They just take their guaranteed fees off you, including the financial advisors, right? They're the ones that they always get paid whether you make money or not, which is, I think, criminal. So that kind of life that I used to be on that other side of the curtain. And then all of a sudden you pull back the curtain, you see the wizards, just this, greedy, rich piece of crap, at Goldman Sachs or whatever, and you're like, oh, they're just trying to teach you all these money rules so that you pay them money versus making you money. And all these people are retiring broke, and that's the truth. 2% of people in Fidelity have at least $1 million out of the 45 million clients that they have. Only 810,000, almost 900,000 now, have $1 million or more. But Transamerica did a separate study of those same people and found that 35% of them think it'll take a miracle to be able to retire. They only think it's possible. Because if you only have $1 million living on 3% a year, that's 30,000 a year. That's below the poverty line. You're a broke millionaire. And so for them, like usually you have to have at least two, three, four, $5 million before you have finally a middle class lifestyle. And most people just don't do that, not because they're not saving enough, but because it's the wrong place. And that's why we need alternative investments. That's why we need to do stuff like this. And so that's where, as you can tell, I'm a little bit passionate about getting people away from that. And that's why I think it's so important for me, not just because I don't want the liability, although that's a cool perk, right? And I don't want to, and I know I don't trust myself to do the active investments, and nor do I have the desire to have to go and figure out all that stuff and look through hundreds of deals and see if it matches my buy box or not. Like all that kind of that work. I think only somebody, the only person that should be doing that is somebody who gets fired up, like that just wants to eat, sleep, and drink it. Those are the people you want doing that stuff. I'm just not that person. I'd much rather be teaching. That's what I'd love to do.
Yeah, and so you've done 10 deals so far. You've
Mhm.
you've done across a couple of these different asset classes, multifamily, oil and gas, debt. What I hear from many LPs that come through my door of like, where should I be focusing? What do I what asset class should I go into? I have my own thesis. My thought
Uh-huh.
is like it depends on what your goal is. If you're trying to
Yeah.
go for income versus equity growth, or are you trying to get cash flow now or in a couple of years, or how do you look at that? And how did you pick these to be a part of your portfolio?
Yeah, like so I'm kind of agnostic, right, when it comes to it. So yeah, when I started looking at syndication specifically, right? I mean, I thought it was awesome. I thought it was an awesome idea. I mean, I never knew even what the word syndication meant in the mid 2010s, right? Because I was always partnering on deals, So I started to learn this whole new terminology as I came back around and started having money again. But the thing I love is, of course, that you do get that, the upside, you know, potential. You get that upside gain. You do have an asset that's secured, usually should, if you're assuming you're in a good investment, and it's not, you don't have a bad actor that's taking your money or anything like that. But yeah, like I mean, really finding those deals that again somebody's sourcing them, they're figuring out, then I can take a look as well and do my own analysis and see if that's something I'm willing to take the risk in being in. So I think it's great. I mean, the fact that you can go into anything from multifamily to commercial, industrial, self storage, or all that kind of stuff. I mean, some of these things got kicked in the teeth the last few years, but I mean, especially in the 2010s, I mean, those things were just roaring away, right? I mean, they were just doing amazing things, especially with these low interest rate environment we were in. So I think it's a great thing to have because sometimes they can provide income, but they can also provide growth. And if you're trying to try to do like what I've done, right? Become work optional where you have enough passive income to pay your bills and then some. You need to have some growth in your portfolio. You can't just have income only, right? Like when we talk to our clients, like you can do income only, but you might have to get your income to 50% more than that, like a 1.5 times more than what your expenses are. Because if that doesn't go up, but inflation keeps going up, you're going to see your income capped if you don't get anything with growth in it. So I think it's really important to have growth in your portfolio. And that's why having equity, type investments, which most, syndications are, that's where you have that advantage. And it doesn't have to just be real estate. I mean, I know there's, you'll see things like car wash businesses are starting to become more popular right now. That makes me a little bit nervous, when you start to see a lot of people jumping on a bandwagon. That's usually when you start to see things kind of spike a little bit, and that's when they can, have too much risk. I like to get into deals when people hate them, which is why I'm kind of looking forward to multifamily right now because especially with multifamily, they've been hurt so bad the last 3 years. You can kind of see you're getting kind of near a market bottom because nobody wants to be a part of it. People are trying to get out of the deals, not get in, and that's a rare opportunity. So if you have the right operator, I think yeah, you definitely have some good advantage and even like a possibly good timing right now. Looking back at multifamily again.
I know you used to have this idea that you should invest in like 3 to 5 trusted operators, and now your thinking has switched to being much more diversified. Walk through why that change in thinking.
Yeah, like I don't really have anything against like having maybe 3 to 5 operators being like a good bulk what you have. But I used to, I mean, I would get tired of people saying like you got to diversify. And I remember there's this one dentist I worked with that seriously he had over like 43 different investments, Some of them were multiple with the same people, but it was like he probably had easily at least 12 different operators he was investing in. So he's just like throwing spaghetti on the wall, right? It was very haphazard, not to mention the stress that his wife had because she's like, "You do not die." And this guy, by the way, is in his 70s. She's like, "You cannot die because there's too many. I don't know how to manage this all." I'm looking at him like, "I don't even know how you manage it all." He's like, "I'm literally spending my retirement managing my investments." I'm like, "You are like, this is ridiculous, you know?" Because he would do like 25, 50,000 with everybody. And I told him, I was like, "Listen, let's double down." This is something I teach people like in my fifth phase of the five phases. When you're multiplying your investment returns, I talk, people always talk about compounding interest in the financial advisor world. I talk about compounding income, right? And building and just compounding on that passive income more and more. I was like, listen, as you start getting paid out from these deals, why don't you start doubling down on some of these operators that you really do like, the ones that are like legit, they're working out. These other ones, hopefully you get your money back anyways, which he for the most part did. But I was like, let's just have you focus on less operators this time around. Instead of like 12 to 15 operators, maybe keep it 5 to 10, right? But I definitely believe that diversifying is important, especially among different asset classes, even within real estate is very important. So, like, for example, I mean, I have oil and gas investments, but they also are backed up by the fact we own the land, right? So it is a real estate venture, but it's more of a business partnership that we're in. I also do raw land investing because raw land investing doesn't give a crap about cap rates. you know, we don't have that kind of complexity. So I have a raw land partnership that I'm doing as well. That's cash flowing very nicely. Obviously turnkey real estate, single family versus multifamily, or even like duplexes, things like that versus doing multifamily. Self storage. I'm not in any of that right now, but maybe in a year or two, if the prices finally get back to normal again, might be a great time. So that's why I do that. It's not just different operators, but also different assets within that, so that if there is something that gets stressed out, like multifamily got hit hard, and it did affect some of my investments. I had some where I didn't get my money back, like one particularly. Others, I got my money back just by the skin of their teeth, if that's even a thing. I don't have any skin on my teeth, but you know what I mean, right? Like they just barely got out and was able to get my money back, but not really any interest. But I was very fortunate that I was very diversified because I had turnkey properties that were doing just fine, that were doing well because they bought them when rates were lower and they're cash flowing like crazy and they're still appreciating and making massive returns. I had raw land, I had oil and gas, I had a lot of different money in different places. I was even lending my money. I started last 3 years when I saw the interest rates going up, I started switching to lending instead, which is not really in any kind of syndication, but that really helped a lot. And it also was really the best thing that's been generating income lately too. So going more to that aspect, and switching. And then as markets do shift, you can switch back over, right? So it's kind of cool. You can kind of maneuver it and do it just like people do in the stock market, people that know what they're doing. You can do the same thing in real estate too. You can move your money around into different classes or subclasses, that could actually be paying really well at that time.
So there's been a lot of, you mentioned if you were in commercial real estate anytime in the last couple of years, you've been hit pretty hard. And
Mhm.
I get a big sense from the community if you were newer to passive investing anytime in the last 5 years, that many people are just getting out. They're like,
Mhm.
I don't have any control over the deal. I've lost, my money, pretty much, the 5 deals or less that I've invested in, I stopped making distributions and they're pretty down and saying like, why would I ever do this again? And
Yeah.
so, as someone who's been on both sides of that, and I'm biased as well, but why are you, I guess, still so pro LP investing in this way?
Yeah, I mean, because the truth is that there's always great deals. There's always something out there. If you find the right operators, I think that's the hardest part is finding the right operators. And even if you find operators that have decades of great track records, I've watched some of those operators still have risk today, right? And so, yeah, I'm actually still a fan. I still think I still have faith in it, even if I know the timing may or may not be right. For example, I have one friend, he's out of Florida, a multifamily operator, and he's like, dude, I haven't done anything in 2 years. He's like, I see hundreds of deals. Nothing has fit my own personal buy box where I feel like I can justify it, which creates a lot of stress because he's like, I've stopped raising capital. Like, I don't want to raise any more money. He's like, I'm just trying to get out, exit the deals I already currently have. And his was, of course, the typical thing of value add, refinance, get out, that kind of thing. And now he's like, well, that strategy is not working right now. And so no, I see this as a temporary blip, but that's got to happen. I mean, if those guys are saying they're more stressed out now than they were in 2008, that should tell you something. As an LP, if you actually did have, multifamily, maybe you got some deals or not or whatever, you just survived the worst real estate for multifamily operators over the last several decades. Like, you possibly saw once in a lifetime, you could view it as an opportunity for learning, or you could view it as an opportunity for losing money. But you just literally witnessed it, over the last, 3 years. And so I'm not saying I ever want to lose money, but there should be a lesson you get out of it. And the lesson is, it should never be, I'll never invest with that person again. If you ever say that, shame on you. You just lost the lesson. That's not what it's about. Yes, the jockey is more important than the horse, but understand that a lot of times it's more about what went wrong, right? Why did it happen? The reality is that the reason why even good operators lost money is because who knew that interest rates they all knew it would go up. They just didn't know it would go up so fast to the point where they couldn't adjust and everything just blew up. That's the feds. The feds make those decisions. That's a good learning opportunity. That's because when I look at deals now with multifamily as an example, I don't want to hear, hey, with the value add and everything we do, now it should appreciate for more. I don't want to, again, quote unquote, bank on appreciation, which has always been my thing ever since the last financial crisis, right? I learned not to bank on appreciation. Now, instead, I tell people, I was like, no, I'm looking for cash flow. Does it cash flow today? So right now, I know an operator that they're actually looking at doing a commercial deal in San Diego, right near the Gaslight District. Or sorry, not Gaslight District, gas lamp, I think is what it's called. Whatever it is, downtown San Diego, right? Great commercial property that they're buying for dirt cheap. And even if they don't see any appreciation, the cash flow is enough to not only just pay for their expenses, but actually have income. To me, like that could be a potentially good deal. And I want to look deeper into it before I just throw my money in. But I look at that, it's like, that's good. If this thing is already profitable, you don't have to make money, or you don't have to have the value go up for you to be able to make this thing work. Like, you could stay in it for years and this thing will cash flow nicely. Great. That means it can stand on its own. I don't want the thing that says, hey, you're going to basically make no cash flow for the next 4 or 5 years. By year 5, when we sell, you're going to make a lot of money. Those ones, I'm like, no, like, keep those away from me. That's the old model, the old mentality. Doesn't work in this environment. You can't do that. That's the easiest way to lose money fast, right? So yeah. So look for those things of what should you have learned versus just, oh, that guy sucks. Like that just does you no good.
There's something I want to just pull the thread on here, which is this idea of the strategy of the BRRRR method: buy, rehab, refinance, rent, and repeat, is a strategy that doesn't. I'm sure there are operators that have figured out how to do it, but largely it is not as easy to do that strategy as the last decade. And so,
For sure.
if you agree with that assumption, then the question is, what are the strategies that work today? I think that's just an interesting way to think about it, because the environment has changed,
Mhm.
and that's what creates opportunity. And you can't just invest in the same strategy for 30 years. Yeah, you have to abide with the times. Um,
That's right.
so I want to, we only have a little bit of time left. I want to quickly dive into something that's, I think, unique to you, which is, you also teach quite a bit about infinite banking. This
Mm.
concept where you take a whole life policy, you fund it, and you can kind of loan against that policy to yourself. And maybe you give me a quick overview of that, but I would love to dive into how you use that with your investing strategy. Does that mix in with some of your LP investments? Is that only for active things? Because I think it's a good tool to have in your investing portfolio.
Yeah, it can be. I'll tell you, if you do it the way that most people talk about infinite banking, you're probably going to get ripped off. And I learned that firsthand in 2006, actually. Funny enough, for those that don't know what infinite banking is, it's a strategy of constantly keeping your money in flow. Much like we were already talking about with real estate investing and everything else, like always keep reinvesting, kind of compounding your passive income. Well, infinite banking is using whole life insurance as a tax-free high yield savings account that you can use to flow money through. Most people will teach you from the traditional strategies of you can buy your cars with it or buy your houses with it and you pay yourself back interest, quote unquote, right? Which is actually a kind of a half lie or half truth, depending on how you look at it. There's a lot of different myths and lies around infinite banking that I don't like. And I bought into it hook, line, and sinker in 2006 when I was starting to learn about this real estate stuff because all these real estate investors that I knew at that time were talking about this infinite banking concept. Granted, as a financial advisor for 4 years, I'd never even heard of it before. Now, mid 2000s, it wasn't as popular. We didn't have YouTube, like things like that, but I'd never heard of it before. And so I remember hearing about the strategy and they're talking about using whole life insurance, which I'm like, that's the worst insurance to buy. Like as financial advisors, we ripped on whole life insurance. I didn't know anything about it other than what other advisors taught me to teach, tell you that it's bad, right? I was telling people to do stock market related stuff. If you did life insurance, maybe like a variable universal life, so you get the ups and downs of the market, or index universal life, which at that time wasn't popular, but now it is. I was teaching people to do that kind of stuff. And so when I heard about whole life, I'm like, why'd you guys do that? But I read the book, the Becoming Your Own Banker by Nelson Nash. The Nelson Nash Institute's the one that talked about and kind of created this strategy. I was like, okay, I got it. Yeah, you could buy cars with this or whatever. You pay yourself back interest. I'm like, it must be good because all these other real estate investors like it. I'll get one too. So I kind of went off faith. Now, when I saw the numbers from the insurance agent that I went to, remember I had an insurance license, but I was using an insurance agent because I didn't know how to do it myself. I looked at the numbers. I said, dang, this is really expensive up front. Like, is there a way I can pull different levers? Because I know I could do that on other kinds of life insurance. Can I pull different levers here to get more cash in it? And the agent told me no. He's like, if you try to put more cash in, you'll get taxed, which was half true. The way he designed it, if I try to put in more than what he said, it would tax me. So I was like, well, I hate taxes, so don't tax it. Well, 2008 rolls around. I was in the hole 15,000, 16,000 a month, right? I couldn't afford to keep paying $1,000 a month. I paid 25 grand into that policy. I called the insurance company. I say, hey, listen, can I stop making payments or can we do something to make sure this keeps going? They're like, no, because you have no cash in it. So it can't self-fund it all. It's basically almost like really expensive term insurance for you. And I'm like, so if I stop paying, I lose it. The 25 grand I paid into this, it's going to be gone. They're like, yeah. I'm like, well, I guess I don't have a choice. So I blamed the recession on it. Months later, I started looking a little bit deeper into it. I realized that insurance agent lied to me. By the way, this guy was one of my best friends by this point, but he had lied to me. So I actually went, I had a 2-hour debate with him in his office. I ran my own numbers because again, I had an insurance license. So I started doing my own research, ran my own numbers. I showed him how he could have more cash from day one, where his would have no cash for 2 years, right? And we went back and forth. And finally, after I knocked down all of his little objections, he's like, well, you should have a big death benefit, yada, yada, all that kind of crap. And once I knocked down all these objections, I even matched his death benefit and still had more cash. He's like, Chris, I did it that way because I couldn't afford to cut my commissions. Like, there's the truth. There it is. And so I was like, I'll never send you any of my friends or family again, and now he works for a bank. He's no longer in the insurance business. But that's the thing, like it pissed me off. And so really for now, the last 17 years, I kept finding ways to refine it and do it better. I would try to find guys to do it for me. But every time I tried to find somebody to do it for me, same thing would come up. Their self-interest would be at play. And yeah, they would still get cash in there from day one, but it wasn't as good as I know they could do. So I was like, wait, why would some of these people have less or more? What is it? Like, well, if they do a bigger policy, well, then I'll make sure that the costs are better for them. But if they do a small policy, well, I want to get paid too. So I'm going to do, smaller. I'm going to not give them as good of a deal. And finally in 2017, I was like, that's it. I'm bringing this in house. Like I'm doing this myself now. And so that's why we started doing it ourselves, because it's like, I can't find any of my contacts, friends, anybody in the marketplace, any of the guys you see on YouTube that talk about infinite banking, none of them will do it where you get the max ROI possible on that cash. Because really for us as investors, isn't that what we want? We want liquidity, we want cash. And the way we use it is different, because a lot of those guys will say, yeah, build up that cash and maybe you invest with it. Maybe they'll tell you to do that, especially in the real estate space. They'll tell you that you got to pay like 30 or 40% in costs up front, which is BS. You don't have to. It's more like 15 to 20% in costs up front. And that's the worst year. But that's the thing. Like people will see it. They're like, yeah, but if I put money here, then I can't invest it. And so I teach a very different method with that, what I call max ROI infinite banking. Because as a passive investor, You don't want to throw all your cash in this policy like some of those guys teach. You want to have a good balance. Now, many people are saying, well, I've been using a 401k. Well, stop it. The 401k is the worst place to put your money if you want to be financially free because you lock it away in prison. It's like putting extra money towards your mortgage payment. If you lock up your money in equity in your house, remember my story? That was a bad thing. I couldn't get that equity out when I needed it. Even when I tried to sell the property, I couldn't get it back out. Your best thing is no, do your 30-year mortgage, pay your minimum payments, keep the equity outside, stay liquid. I call it get lean, get liquid, and get out. Get lean means be a wise steward, track your money, make sure you know what's going on with income coming in, income and expenses going out. Get liquid means I have liquid cash in my pocket, even for emergencies, but also for investing. So then I have money to get out for creating passive income. And so this is a big part of that. This is part of that get liquid part. You even mentioned about the burst strategy, right? Like the hard thing, burst strategy works great if you don't have a lot of money, but it has changed. You might have to take a longer time horizon before you can get that money out. Where with this, like I just tell people like, hey, you got $50,000, keep saving. Like keep saving, keep packing away until you have a couple $100,000 where you can start diversifying among multiple deals and not be fully exposed in any one place. Great. Now we're talking, right? Get at least $150,000, $200,000. Now we can start doing some stuff. Until then, you just keep building up savings. And so I have people use infinite banking, like using the life insurance where they get, again, lowest cost possible while keeping it tax free. And you're using that like with those first few years, just use your emergency fund. The money you're not going to invest, throw that money in there, the emergency fund money, almost like moving from a savings account to a high yield savings account. The difference is the reason why you want to use a life insurance is for a few reasons. One, it's tax free. It is a tax free savings account. It does not get taxed ever. It's like a Roth IRA, but you can actually access it. There's no like dumb little rules like 59.5 rules, or if you try to pull out before then, any gains get 10% penalty on, right? Or if the government changes their mind and they change the rules on you, then you have to go with those rules, whatever they say the Roth is, right? So Roth is not bad, but this is better because I can access this money right away. I can access it in my 30s, my 20s. I could technically retire with it in my 20s and 30s, but I can also use that money right away if I want to invest and actually make money in two places at once. That's another thing too, is that you can actually have your money still in the policy, borrow from the insurance company. This is why you don't pay yourself your interest back. You're paying the insurance company when you borrow from the insurance company. But if you use it to invest, they're still paying you money on all that. So if you have 100,000 sitting in your policy, you borrow 50,000 from the insurance company, your 100,000 is still earning right now about a 6% tax-free compounding return. So you're making about 6% of your tax-free. That's actually comparable. That's actually better than what they predict the stock market will do the next 10 years. They predict the stock market will do 3 to 5% maybe. But here we're getting 6% tax-free. I borrow from the insurance company. Yes, I pay them interest, but I can pay them back whenever I want. So I use that money to invest. I get that money back out from the cash flow, whatever it is, the returns. I use that to pay down the line of credit. So the simple interest I pay them goes down while the compounding interest goes up. I actually make money here while also still making money in my investments at the same time. That's how you can kind of have your cake and eat it too. You double dip on your investment money.
So you're basically funding a whole life policy, and then you're taking a loan out from your policy to make active or LP investments.
Yeah. After I build it up enough to have enough emergency storage in there, I keep my lion's share of my emergency fund in there. Anything above my emergency fund, that's what I'll invest.
So how are you, I guess, in preparation for this, I looked at, I have a whole life policy that I have around like 40 grand in, and I have been funding it. And it is one of those policies where I can take a loan out against myself. And the interest rate currently is at 8%. And so to me,
expensive.
I'm asking myself, okay, that's expensive. Like in what world, like, okay, maybe 4 years ago, maybe interest rates were lower. It made a little bit more sense. It's an adjustable rate. At least mine is. They reset every year. So if interest rates continue to go up, my debt burden will continue to go up, like the U.S. government has that situation right now. So I view that as very risky, and you're telling me about this. I've heard a lot about the strategy, and it just doesn't compute in my head. And to take risk, I have to know I will make significantly more than 8% to be willing to take on, I guess, that kind of leverage. So what am I missing? Do I not do some people like me not have their plans properly set up?
Exactly.
Or, is it just a reflection of the times, or how do you look at that?
Yeah, understand this. Just like I mentioned, like not all infinite banking policies are created equal, and neither are whole life insurance policies, right? A lot of companies don't encourage you to use the policy, which is why they'll charge you 8% to discourage you from using it. They want you just to use it as like this supplemental retirement to use someday. That's how most people sell whole life, right? Is you just put the money in and finally decades later you can access and do stuff with it. That's not how I look at this. I look at, again, having that flow of money, having that ease of access of liquid cash. So like you pay 8%. The company I use is 5.3%, right? And like I said, I'm getting paid dividends of 6% a year on it. So that's the thing is like, and by the way, you can play the interest rate game. If rates come down again, guess what? There are special banks that actually give what they call I blocks. Like instead of HELOC, like home equity line of credit, they have an insurance bank line of credit. Right now, they're just a little bit higher than what the insurance companies will offer. They're like right around like 7% ish, somewhere in that ballpark. For you, that actually would be better, sadly enough. But right now, because I can get lower at the insurance company, I'm going with the insurance company. But 3 years ago, I was paying 3% while they were paying me almost 6% on my money. I mean, and I was still investing it. So I was making bank, literally. Like I was making like, it didn't matter if it was like a 10% a year, pref on a multifamily deal. I was making more like 13% on that money, right? And so it's a little bit closer now because of where the interest rates are, but you can play the interest rate game and go back and forth. But yeah, it's not about the what the insurance agent says. It's not even about the company you use. Because I've seen people use good companies poorly. It's about how the agent designs the policy. Can you make it as cash rich, as low cost as possible so that more of your money goes there? And of course, if you use it, you're not paying 8% a year, which is really high for an interest rate right now for a policy. So yeah, that's the case. They're not all made equal. It's just like, I was on a Ryan Pineda show. I don't know if you know him or not. He's got a kind of big real estate podcast. We were talking about infinite banking. He hates it. He hated it up until our conversation. He had 4 other infinite bankers on. He's like, yeah, I keep hearing it, but Chris, I can make more money elsewhere. I'm like, well, of course. That's why you invest elsewhere. Like, that's the point. What he didn't know, though, is that all of the cash inside the life insurance policy in most states is 100% protected from lawsuits and creditors. So not only is it paying 6% a year, tax free, but you can have millions of dollars in there and no one can get to it, even if they sue you, including if you're a GP, not even just an LP, right? But more of a GP. Someone sues you and wins, they cannot get to this money. It's one of the only places you can keep it besides a 401k. That's also another place to protect it. But the problem is it's protected from you too. You can't get to the 401k, right? You have to quit or get fired to even access the money. Not a good plan. So that's why I use this instead, right? So again, I'm using this more not to invest all the time. I'm using more as a place to store my cash, to build up my dry powder, even if I'm looking to invest. Even if I'm like, you know what, I want to wait just another 6 months to see what multifamily is doing. Maybe I'm going to hold off and build up some cash that gets paid out from other deals. Where do I store the cash? I can store it here, let it sit there for a while, earning my 6% tax free, rather than point nothing percent at my bank that I get taxed on. I mean, even my wife, like she wants $400,000 just sitting in reserves that we never touch, right? Well, that $400,000, like if I kept that in my 0.05% credit union bank account, my savings account, I would make $200 a year and then pay taxes on that $200 a year. So I might walk away with 150, 130, 150 bucks. But here I keep 300,000 of it in my policy that we don't touch. Anything above it I can, but not the 300,000. So I'm making 6%. That's 18,000 a year tax free. Way better than 100 and whatever bucks. But I still have 100,000 in the bank too, because if there's money I need to get to that day, I can do it. And the insurance, it might take me about a week to get to that money to transfer over to my bank account. So I still use banks, but I use them a lot less. But I'm also using it like for college savings. Did you know that it actually doesn't count as an asset when you're saving for kids' college? A 529 plan, if you're saving for your kids' college, counts as an asset. It counts against you when you're trying to get that FAFSA. You're filling out the forms to get financial aid. It counts against you from getting scholarships and grants. But in the policy, it doesn't count as an asset. But guess where it does count as an asset? When I'm getting a bank loan, they will count it as liquid cash reserves, just like it's a savings account. So it counts when I want it to count, but it doesn't count when I don't want it to count, right? So even if you don't use it for investing, the thing is just as a great place to store cash, it's a great place to keep it, right? And especially if you're investing in a lot of places you might feel is risky. If you're like one of those Bitcoin people, like you might need cash on the side you can always count on that will always pay out. In fact, even the insurance companies I use for my own policies, they've been paying, one of them's been paying out since 1847. That's like pre-Civil War. It's always paid more than their minimum guarantee. So like that's the thing. Like I go for something that I know I can always count on. It's always going to be there. I can access it to use it for investing. I can use it for my business and get right off the interest that I'm paying to the insurance company or the bank. Right? I can do all kinds of stuff with it. But the whole point is that again, I have liquid cash. And for people that are saying I need to build up so I can invest more, great place to store cash, and you don't have to use it all the time to keep investing. Don't think that it's like you have to keep moving the money all the time. I think that's more pain than it's worth.
Okay, and I think that's the cliffhanger. What a good cliffhanger to leave them on. Chris, if people want to learn more about you, how you help people, maybe talk about infinite banking or work optional life, where can people find you?
Yeah, anything that's Money Ripples. It could be moneyripples.com, at Money Ripples on social media, or even the Money Ripples podcast that we have that's on our YouTube channel, the Money Ripples with Chris Miles. We got that there too.
Amazing. Cool. Chris, thank you so much for joining us today. If you're a listener here and you want access to deals that we're talking about, one of the best places you can find them, I put out new deals every Friday. I have this thing called the Passive Investing Starter Kit. And so if you're interested in deal flow, I would recommend going to passiveinvestingstarterkit.com. And with that, here on the Passive Income Playbook, it's part of the Best Ever CRE show. We will drop episodes every Thursday. So if you love these, be sure to tune in. And also, if you have any feedback or suggestions or just want to give any feedback that you loved the episode, I'd love for you to reach out on LinkedIn and say hi. So with that, thanks for tuning in, and we'll see you next week for another episode of the Passive Income Playbook.